I think you've seen Chinese equities in general rally back up to those kind of pre-Liberation Day levels, and so we're running into a little resistance as we kind of what technical analysts would call filling the gap. And I think ultimately we're seeing a positive path in U.S.-China economic and diplomatic relations, and I think as long as we maintain that path, as we're hearing of U.S. and China trade negotiators meeting at APEC in South Korea, if we can stay on that positive path, I think it allows for a China re-rating. At the same time, fundamentals do matter, and you're seeing the strong results from NetEase leading to some strong performance there, where conversely, Alibaba, a bit of a miss in terms of their Q4. And so obviously the stock had been up 58% going into earnings. So we're seeing the lack of fundamental follow-through weighing on the shares here.
I'll get into the tech and the earnings report cards in a little bit. I just want to ask one more question about the trade de-escalation. Our very own Lin got a chance to doorstop Li Changgang, that is the top trade negotiator for China. And when asked about the discussions with the United States, he replied, good and constructive. In terms of the direction of the markets, what's going to be driving it?
Well, I think for many global investors, the U.S.-China, the very poor diplomatic relations under the previous administration has acted as a significant headwind for investors to allocate to China. There's lots of concerns about the Biden policies to trying to cripple China economically and technologically, as well as I think there was a really lack of corporate interests, their views being allowed to be expressed or influencing the view of the Biden White House. At the same time, the Trump administration, I think, is very geared to corporate interests. And I think you're seeing after Tim Cook's meeting about a month ago, you saw how the tariffs on electronics was lowered. Just a few weeks ago, you had the CEOs of Walmart, Target, and Home Depot meet with President Trump. I would assume that they spoke to him about diminishing inventories and having to raise prices due to his tariffs. And that led to, I think, what was, again, a very strong first step in terms of U.S.-China relations improving. And I think investors maybe underestimate the power of a positive path in diminishing some of that geopolitical headwind that's left a lot of investor capital on the sidelines investing in China, despite since January of last year, some really strong returns.
I want to take stock of U.S. ownership of Chinese equities. I remember David Tepper when he went all in Alibaba. Now he has since cut his BABA holdings by 2.6 million shares. It makes up about 14.5% of his top holdings. How are you seeing U.S. ownership of Chinese equities being impacted by the tariff war, and what is the impact on ETFs?
Yeah, I think certainly for David Tepper, as a hedge fund manager, he can trade. And remember, these 13Fs were as of the end of Q1. So I think a lot of fast money, the proverbial hedge fund managers going into Liberation Day probably wanted to hedge those positions or reduce them. It'll be very interesting to see if he bought that dip. I think that's where a lot of there's two investors in the U.S. who are very, very positive on China. One are the hedge funds who are taking advantage of say, K-Web's option liquidity and on-screen liquidity to be able to trade around position. And the other are technical analysts where again, if you look back to January of 2024, you have really strong returns in China, and it's been two steps forward, one back, and yet that's what technical analysts would call an uptrend, right? Higher highs and higher lows. So despite all the volatility which lends itself to these traders, you do have this positive uptrend, and I think there's a lot of capital that's still on the sidelines because of the geopolitical narrative. And again, I think if we stay on this positive path, you'll see a re-rating there.
You were recently stateside and with Congress educating them on ADRs. What was the message?
Well, one, that the U.S. and China are very intertwined economically, and while we've kind of suffered from a deterioration of U.S.-China relations around, partly because of COVID, but I think I think one was to talk to members of Congress about how important China is to the U.S. economy, and at the same time, China is very important to, or the U.S. is very important to China. But then it was really about educating folks that the U.S. listed China ADRs, they're adhering to the Holding Foreign Companies Accountable Act. The Chinese government changed Chinese law to allow them to adhere to U.S. law. Delisting U.S. listed China ADRs does not hurt the Chinese government. It should not be used as, if anything, it would jeopardize U.S.-China trade talks, as well as just really providing some insights into how these growth companies within broader China have actually performed quite well, and that positive performance would be very detrimental to U.S. investors to implement capital controls that don't allow that. So I think it's a very, very exceedingly low probability of any sort of ADR delisting.